And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week as we get ready to wrap this week up. And a quick reminder that next week, I will not be here. I will be on vacation next week. It is spring break, taking my kids skiing for the week. Be back the following week, though, of course. But don't be distraught because Brent Clinton has done a fantastic job of organizing all of some of our best of clips, and they're going to be all on our podcast channel. So simply go to SoundCloud, Spotify, Apple, iTunes. Wherever you get your favorite podcasts, you can also get the Real Investment Show podcast, and you'll have enjoyment all week long. And then we'll be back for the next live show right here on YouTube the following week. So you're not going to miss a thing, right? Other than the market crash. Other than that, historically, when I go on vacation, the market crashes, but that's just the way it goes. So we'll see what happens. But again, try to be sure and tune into our podcast. If you don't use our podcast or haven't checked it out before, you get all of our feeds right there on our website, realinvestmentadvice.com. Just simply go to YouTube podcast under resources. All of our links are there. The daily playlist are there. It's all there for you, just to make it really easy to get to. It's all at realinvestmentadvice.com. Okay, so a couple of things. Yesterday, the market rallied very nicely, coming off the lows, as expectations are that Trump will delay tariffs somewhat, at least on auto companies. And so that helped give the market a bit of relief. Now, this morning, futures are back down again. We're going to be down about 1% at the open this morning. Chip stocks under a bit of pressure this morning. Not sure really what's driving it. There really wasn't any news out overnight of any consequence. But again, we're just still in that process of kind of unwinding that previous rally that we had all of last year. We've had 2 years, 20% gains. Not surprising you're getting a bit of turbulence in the markets, as they say. One of the things I was thinking about during President Trump's address to the Joint Congress, not last night, but the night before, he talked about tax cuts for the working class, and one of those was being able to deduct the interest on your auto loans. That would be really cool, right? So you have a car, and now you can deduct the interest that you pay on that auto loan. Well, the deal is that really there's a lot of people out there that have zero interest loans, those type of things, very low interest rate auto loans. Still would certainly help. But what people often forget is that up until October of 1986, you were able to deduct the interest on all your credit cards. And Ronald Reagan, when he passed the Tax Reform Act in 1986, that removed that ability to deduct that credit card interest. But when I was growing up, you used to be able to deduct the interest off your credit cards. And can you imagine, with the amount of credit card debt that Americans have today, what a big economic boost that would be if you could deduct your interest on your credit cards. So just saying, it almost also might encourage people to run out and get a whole lot more credit card debt. But we'll see. But again, we're talking about, giving people no tax on overtime, no tax on Social Security. These are all great things. Help provide people a little bit more money to spend at home. Certainly would help boost some economic growth to offset the risk of tariffs. This morning, really great chart. I posted this out on Twitter this morning, showing the annual deportations over the next 4 years expected under the Trump administration. And so it shows the projection of what the immigration and removals are expected to be over the next 4 years. It also shows what it's been over the last, really since about 2010. Going back to about 2005. Shows the annual removals and deportations from the U.S. 5.4 million were removed during the Obama administration. And the expected removals now are going to be somewhere between 6 and 7 million. So the point about that is that during the Obama administration, we had a very large removal of illegal immigrants, unauthorized immigrants in the United States. And it didn't. And the thing was, it didn't crash the economy. It didn't, cause, a massive economic disruption. Companies adapted. They hired U.S. employees. Wages actually kind of rose a bit. The economy did fine. Inflation didn't spike. So again, this is why when we talked about tariffs the other day, we went back and looked at tariffs during the previous administration, during the previous Trump administration in 2017 through 2019. And again, when you hear a lot of these headlines, there's so much of this doom and gloom that's out there right now. It's like, oh, everything that's going to happen is going to crash the economy. Go back and look at the data, right? And the data just doesn't support a lot of those things. But again, this time could be different, and certainly need to be aware of that. So, speaking of that, here's what you need to know before the bell today. Markets are, as I said, are looking to open lower this morning. Again, not any real news overnight of consequence. The market rallied very nicely yesterday, coming right off the 200-day moving average, holding that support level. We've held the 200-day moving average for 2 days in a row now, so we're going to retest that again today. Now, again, as we talked about before, be careful with breaks of support. It is possible that over the next couple of days that the market tries to come down, retest the 200-day moving average, breaks that. Be careful with becoming very panicky at that moment, making a lot of big sell decisions, because we've seen breaks of the 200-day moving average several times over the last few years, and those turned out to be buying opportunities, not selling opportunities. And again, not saying that this time is different, not saying that this time is going to, cause a much bigger decline in the market. That could happen, right? There's certainly a lot of concerns out there right now. But as we saw yesterday, the economic data, a lot of concerns over the last few days about the GDP Now showing such a negative read. That is going to improve rather sharply here over the next couple of days at the next print when the GDP Now number comes out, because we had very decently improving ISM services and manufacturing data. So that's going to feed into that report and show an improvement in that economic expectation of the report. So again, we'll probably see some better economic report. We have the employment report out on Friday, likely going to be better than expected. That's going to feed into that data as well. So again, be careful when everybody is very negative. Just be careful that you're potentially going to get some counter trend data to help support that. But again, markets here very oversold. Again, as we talked about, sentiment-wise, sentiment is just about as negative as it can be at this point in terms of investor sentiment. Positioning sentiment is also very weak right now. So you've had a lot of selling, a lot of deleveraging in portfolios. And again, so once you've had all this selling, we're now starting to find out where buyers are living. And we've talked about before that sellers live higher, buyers live lower. And that's where we're currently getting to right now. Now, I've got a very long chart of the S&P 500 because we've got to go all the way back to November of 2023 for the last retest of the 200-day moving average. And this is a little bit hard to see for you this morning. I apologize because we needed a long data chart for this. But we had to go back to 2023. We broke the 200-day moving average right there. Markets were extremely oversold in terms of both momentum as well as relative strength. That was the bottom of the market in 2023. And then, of course, we had that rally that started from there, going all the way through 2024 last year. But previous and points worth noting is that every time markets have been this oversold on both the momentum and a relative strength basis, this has been near-term bottoms of markets. So again, I'm not saying that this market can't go lower. It certainly can, but the trend of the market remains clearly positive right now. You're extremely oversold here. So again, I would be a little bit reticent about selling a lot of positions, becoming overly bearish in the markets right now. It's interesting.
On Friday, ADP was very weak, kind of yesterday. But again, there's not been a really big correlation between ADP and the BLS over recent years. Used to be a much higher correlation. I used to run some models, that you could almost use ADP to predict what the BLS would be, but that's really been broken for about the last 3 or 4 years. I'm not sure exactly why that's the case, but they're no longer really kind of good indicators. But we do have that employment report on Friday. That's certainly going to be something markets are watching very closely because of the Fed. Thought it was interesting that, kind of in the psychotic nature of the markets, we went from less than 2 rate cuts at the beginning of this year to now we're pricing in an absolute certainty of 3 rate cuts this year by the Fed.
Yeah, we were actually down to almost 0 at one point. But yeah, like you said, ADP was weak, and I had a model as well that worked great. And I haven't even opened it up in like the last year because it has been so poor recently.
Yeah, we went from less than 2 rate cuts.
Hard data and surveys. Surveys are very misleading, and that's one of the risks that I think exists today. Is that the most real-time data is survey data. So like we had the ISM survey and manufacturing data. And that's about as real-time as it gets. The problem is you're basically asking, some facts, some opinion. And you're not getting hard data on what's going on. And it takes a month or two for that hard data to kind of get released.
Right.
So we've seen all kinds of anomalies in the data, and we know there's a lot of front running of tariffs going on. And when you front run, we saw this with the trade deficit, you're buying a lot more of something in advance. The sellers that are selling it to you are probably saying, look, they're front running, we can probably charge a little more. Prices go up. So these ISM surveys have shown weakness and strength in prices all at the same time. And maybe that's going on. And maybe we'll see that in the inflation data over the next few months. But, until we get more hard data, I would just be careful of all of this survey data. Consumer, University of Michigan, that one tells you the whole story. When they look at the inflation outlook for Republicans and Democrats, Republicans' inflation outlook went to 0, and Democrats went from very low number to 4 or 5%.
Right.
And again, it's the outlook of those being surveyed. So, like you said,
which also is very important to note that, right? Because if you assume, so let's just use a couple of just simple numbers for math this morning, right? Because I think that's a really important point. Because again, one of the things that drives a lot of the narrative in the market is like, oh, look at the sentiment on inflation, the inflation outlook. by these confidence indexes, and it's just surging. And that means we're going to have this surge of inflation, coming back into the U.S. But it's interesting because if you just assume that you had two people in the survey, right? You had one Republican and one Democrat. The Republican said 0. The Democrat said 5% inflation. So your inflation outlook is 2.5%, right? But the fact is that when you're looking at that data, you're having this big surge in inflation expectations, despite the fact that the Republican interviews are saying, no, we're expecting a drop in inflation, which means that either you're oversampling the Democratic point of view, or those numbers from the Democrats are not 5% inflation. It's like 10% inflation, but by the time you average out the Republican decline in inflation, you're getting a 5% increase in inflation, right? So you've got to really dig down into that data. Again, it's all sentiment. It's just, I don't like the president, so I think inflation's coming back. It's not really driven by economic narratives or what's happening on the ground.
Right. And unfortunately, that's kind of that first line of data that we have. Mm-hmm. And I think some of that is scaring the market a little bit because it's seeing these kind of sharp changes in some of these indicators. And, we'll have to see. So we'll get employment tomorrow. The ADP was weaker, almost 100,000 weaker than expected. One thing to keep in mind is that government jobs are not reflected in ADP. It's a private sector gauge. So we'll see what we hear from the BLS. But the tougher part with this is that, yes, there are federal employees being laid off, but alongside there are also others that have jobs that rely on that federal employee. And that's, the federal employee can be the tip of the iceberg, so to speak. Mm-hmm. So it's going to take a while for employment to reflect what's going on in Washington and how it spreads out, not just in the Washington area, but throughout the country. So these numbers are going to be scrutinized, and it's quite possible we get a bad number and the market overlooks it because it thinks it's transitory, or we get a good number and the market also overlooks it for other reasons. So, I think data, at least for the next month or two, there's going to be many narratives floating around about whether it's good or bad and what it means, but it's going to be very hard to decipher. And we're going to have to go back and look, when we get to June, July, and go back and look and really see, is the economy really slipping off like some of these indicators are telling us? Or is it just anxious, nervous, and we're seeing it in the survey data, but it doesn't translate all the way?
Right. And again, what's really important and again, it's important not to overlook is that, there is a difference when you're talking about survey data. It's me going to Mike and saying, Mike, how was your sales this month? And he goes, well, last month, we sold one item. This month we sold 0, so it's terrible, right? It's a function of how they see the action near term. So it's just more of opinion than it is just really kind of hard facts. The questions are you planning on hiring more people? Well, yeah, I'm expecting my business to continue to grow. So yeah, I'm expecting to hire more people. That's kind of always the case. And so again, this is just a lot of survey data. To Mike's point, there's not a lot of hard data behind that. So, that's why we want to dig down. That's why I did last week's report on the Bull Bear Report, our weekly newsletter. We went into the Chicago Fed National Activity Index and looked at that index because that's 85 subcomponents that are all across. It's a very broad swath, a very broad read of the U.S. economy in both hard and soft data, survey and actual data. And that's still running. That just turned in a negative 0.3 clip off that index, again, suggesting a contractionary type environment. In other words, the Chicago Fed National Activity Index doesn't suggest recessions or those type of things. It just says, is the economy expanding or is it contracting? And what that index is saying right now is that the economy is slowing down. Doesn't mean it's about to fall off a cliff, but that it's not growing at an above average pace, right? So we're growing kind of at a below average pace right now in the economy. And that really translates into a lot of this data that we've been seeing as of late. Okay, when we come back, talking about crises, we'll talk about never letting a good crisis go to waste with Michael Lewitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Anybody that's been married at all knows this to be a true story. If you tell your wife something that you know for a fact to be true, she won't listen to you. But if she hears the exact same thing from a girlfriend or from somebody else, it's gospel.
The Real Investment Show podcast.
Danny came up with this idea that we create a fake Facebook page and that you can all subscribe to, and then we will create a fake profile that will answer her in her feed. This is what you need to do, even though it's the exact same information that you just told
At
her.
realinvestmentadvice.com.
I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So we're going to talk a little bit about never letting a crisis go to waste. That's been something thrown around for quite some time. But Mike wanted to revisit the Atlanta Fed GDP real quick. So we'll get to a crisis here in just a second. Go ahead, Mike.
Crisis for now. So one of the things that, we've got a few emails on and comments is the GDP Now. Atlanta Fed puts out GDP Now, which is a great estimate of GDP. The problem, maybe not a problem, but the way they calculate it is they take data as it comes in throughout the quarter, and it slowly builds up to the GDP. So on day one, it just starts where GDP was last quarter. And then you get one piece of data, which is then added to it. So very early on, data has a huge effect. Because you're extrapolating very little. It's kind of like a football game. If it's 14-0 at the end of the first quarter, it's easy to say that at this rate, it's going to be 56-0 by the end of the game. most often it's not that way. So what's happened with GDP now is it started at 2.9%, went up to 4%, and then it kind of got stuck in the low to mid twos, which is about, slightly below the running rate for the economy, normal. And then I think it was last Thursday or Friday, the trade deficit came out. And there were a massive amount of imports, a huge increase in the number of imports. And it dropped it from 2.3 to, I think, like minus 1.5, 1.8. And then there was a little data, some data a couple days later that dropped it. Now it's at minus 2.8. So let's just focus on the trade deficit because that's kind of the big one. People are importing goods. They're front-running the tariffs. This is, to steal a word from Powell, transitory. They're buying stuff now instead of buying it over the next few months. It's going to have a big effect on some economic data, but most likely it's just going to even out over 6 months. So right now, things like the Atlanta Fed GDP estimate get blown out of proportion because, I know it's early March, but all we really have is January data. As we go through March, we'll start getting February data. So, and in fact, the employment number tomorrow is the first real piece of February data. So we're basically extrapolating January out 3 months. So just be careful looking at the Atlanta Fed GDP. Now, if you go look at it in early April, it's going to give you a really good estimate of where GDP is going to come. But there's a lot that's going to happen between now and then, and just more data that comes in that'll kind of even out what we've seen so far.
Well, and we'll see an adjustment today. So the Atlanta Fed data actually adjusts today for the ISM reports that came out yesterday. So we'll see a change in that number today. So again, those reports were a little bit better than expected. So, we could very well see that negative 2.8 become negative 1.5 or whatever today. So we'll see what happens. And of course, the employment report on Friday will feed into that as well. But again, this is the point though of investing, and we talked a lot about this yesterday. Is that for people that are just craving this market to crash, and generally, if you look at these people, they've been out of the market for a long time. They have been trying to figure out how to get into the market. They can't do it because it's overvalued or whatever. But they're constantly in this camp that the world's going to crash, everything's going to end, and that's what's going to happen with the markets. And so this kind of data feeds right into that. But again, it's great for headlines. It's great for clicks and views. It's great for getting you to watch a YouTube channel and go buy gold, right? Whatever, But the point is that as investors, this is stuff we've got to look through and say, what is this really telling me, and what does this mean? And it's very interesting because when markets get really oversold like they are now, as I was showing you during the before the bell segment this morning. There are very few occasions that when you have relative strength and momentum this oversold all at one time, that this was the beginning of a bigger crash. This is typically where markets start to at least find a short-term bottom. It doesn't mean that markets can't start to trend lower over time. That's certainly possible. But we don't really have the economic data for that. The economic data is still okay. It's not terrible. It's not fantastic by any stretch of the imagination, but the world isn't falling off a cliff, economically speaking. Europe is now going through a massive surge in fiscal stimulus. They've been on kind of an austerity plan for the last 10 years. We're now starting to see Germany and other countries in Europe beginning to go to fiscal policy like we've been doing. They're now starting to do that. So that's going to potentially, those countries are on the verge of recession. We could start to see some economic improvement in Europe that would also then feed into the U.S. as well. So again, you got to be real careful when you're investing is to, get kind of trapped into these narratives, because again, narratives are fine for selling a product, but narratives are terrible for investing. And you've got to focus on what's happening with markets. And this is why technicals play such an important role in understanding the short-term nature of the markets. again, long term is fine, but there's been people predicting the market was going to crash since 2009, and we're still going, right? So it's just be careful with the narratives as it impacts your portfolio and your investing strategy, because it hurt in a lot of cases. It's hurt investors more than it's helped them.
That's where I thought your graph when you opened the show this morning is very helpful. Those indicators, the MACD, the RSI, are very oversold. So, it's hard for the market to keep going down when you have fear. The fear greed index, the fear is very high right now. The AAII, which you talked about earlier this week or last week, has only been this low 6 other times, and most of those other times are when the market has already dropped 20, 30, 40% at major market lows. So there's a huge amount of fear. And what that fear is, it's really just the unknown. We have a president with a unique style of management that we really haven't seen before, including Trump's first term. And it creates this unknown. We're uncertain. And I think fear can thrive on that in that type of environment. So, we're getting these volatile swings up and down and up and down. And, it's when we get like this, it's important to pay close attention to the technicals, because if you don't, you're going to let those narratives affect you. You're going to let your gut kind of take over. This is, what we talked about last week with all the behavioral traits that we have. And this is where you have to pay close attention to the market technicals themselves and see what they're telling you. The other thing, Lance, is that tops are a process. The market is not going to fall 50% in one day. We may be at the beginning of a trend much lower, but it will be a process, like a series of mountains, up and down, but where we're continually hitting lower highs. And there will be technical signals and indicators that will tell us to tell the market, tell you to be careful, to hedge yourself, to take off some risk. And, we point some of those out. And right now there aren't many, especially long-term indicators, that are telling us that this market is getting ready to go on a 20, 30, 40% decline. Again, doesn't mean it's not going to happen. It certainly can happen. But the market will alert us, will tell you, we'll have time to get out of positions. We're not going to top tick the market, but we'll have plenty of time to exit. And that's where technicals, when the market is so emotional, become very helpful.
Yeah, and that's true. And this is something that we've talked about, a lot before, is that, corrections occur, markets will decline, but what you need is some type of catalyst. If you're going to wake up one morning and the market's going to be down 10 or 20%, you're going to need something like we saw during the pandemic, where there is such a shocking revelation overnight that the markets can't adjust for that. And all of a sudden, you've got to immediately reprice all your expectations for earnings. If you take a look for earnings right now, earnings growth expectations for the S&P are still extremely strong. They're expecting near 20% increase in earnings for small cap stocks. Small caps are down 15% this year. If you want to talk about a correction, that's where it's been this year. It's been in small caps. But yet earnings expectations are still running nearly 20% on a year-over-year basis. So again, you have to have an event like the pandemic or like a Lehman failure, those type of things that all of a sudden it changes the entire dynamic of the market. And we just don't have that right now. And again, whatever it is, if and when it occurs, it will be unexpected. We will all wake up one morning and be here on the show together, drinking some coffee going, didn't see that one coming. Right. But now we've got to make an immediate change to portfolios. We've got to, we need to increase fixed income. We need to short the market, whatever it is. We'll have to respond to that event, but you're not going to see that event coming. And this is what traps most investors, is that markets get really oversold like they are now, and then they start to rally. And, a lot of investors are getting out of the markets and they're selling. It's like, oh my gosh, this market's just won't stop going down. But this is the point generally where you start to find short-term tradable bottoms. Again, we're not talking about long, we're not talking about buying this bottom here and just holding it for the next 10 years. There's a tradable opportunity forming in the market You have to work through this through options day this month. March tends to be weak through options expiration. Then it strengthens into April. And that's the seasonally strong period that we're in right now. So again, a little bit more volatility here, but the market is probably going to start forming a bottom here sooner rather than later, at least on a short-term opportunistic basis, right? What happens after that? We'll figure it out. All right, quick break. We'll come back, talk about a crisis. Never let it go to waste. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. So Michael Leibowitz just recently wrote an article out. It's on the website now, realinvestmentadvice.com, of course, where you find all of our research that we produce every week, every day, actually. Daily market commentaries, 3 blogs a week, newsletters on the weekends. As I told you before, if you're watching the show, we love having you here. Thank you so much. But you're only getting about 10% of what we actually produce research-wise. So it's all there for you. It's all free. So go get it, realinvestmentadvice.com. So, Mike, never let a crisis go to waste.
So in the words of either Winston Churchill or Rahm Emanuel, and I was never really able to clear up who was the one that actually said it, and it probably was someone else, and neither one of them. But
it was probably Mark Twain. Everything gets it either goes to Yogi Berra or Mark Twain. So generally, any good comment goes somewhere. So, and generally it's Yogi Berra like or it's Mark Twain. Yeah. It's probably not because there's no thee or thou in it. So it can't be Shakespeare, right?
Right. I'm going with Yogi.
Okay.
There is a quote unquote crisis coming up, and we really haven't heard much about it. The debt ceiling will hit in about a week or two. And with that, the government's going to, assuming we get to that point and the Congress can't agree on a bill, that's when the Treasury has to stop issuing debt and rely on their savings account to meet their obligations. The Treasury, again, can only issue debt to replace maturing debt, but no new debt. And it's been called a crisis of sorts. I guess it is a crisis for those that are not going to work and for others, but the government will still be paying all their bills, or a large part of their bills. But what the Fed has come out and said is that it's possible that they will stop doing QT, either suspend it or halt it, if we get to a debt ceiling impasse. And it gets you to kind of question, like, what are they talking about here? Because if we get to that point, there's going to be less Treasury issuance, which there is already because of the preparation for it. We've already passed the limit. We're just not past, we're not really at that point, though, where it becomes drastic. So there's going to be less Treasury issuance. All of a sudden, the Treasury is going to start spending $800 billion that they have saved up. That's liquidity that they took out of the market over the last months, years, whatever it is, building that up. That's going to be released into the economy, into the market. So net, it's actually a positive liquidity event. What QT does is it takes liquidity out of the market. So in this instance, it's a nice buffer, right? You're helping regulate liquidity. But the Fed, in their minutes, came out and said several participants think that we should consider halting or stopping QT. So, that quote, "never let a good crisis go to waste," is meaningful. And might it be a signal that the Fed really wants to end QT? They know that the reverse repo program is running out. It's getting down to near nothing, telling us that the store of liquidity in the market, how much extra liquidity there isn't much anymore. And they can kind of sense that the ice that we're standing on is getting thinner. That, there's still ample liquidity, and it doesn't mean we're going to have a Lehman crisis next week. I'm not saying that. But what the Fed does know is that liquidity is going to start declining, once we get beyond some of this debt ceiling stuff. And they want to get ahead of it, unlike 2019, where they were woefully behind it and didn't see it coming, even though all their reserve indicators told them for 2 years liquidity was drying up. So they learned their lesson. They want to get ahead of it. And it's starting to feel like this debt ceiling could be the chance for them to either reduce QT, stop QT, suspend it, whatever they may want to do. And it would be nice if they could just tell us why, that they're starting to think about liquidity a little more. And with the end of the repo program, it justifies not doing QT, right, versus the debt ceiling impasse, which actually is reason to do QT.
Right. Well, and again, this is, kind of always the situation with the Fed is they can't come out and just say, hey, we're really worried about liquidity of the market, so we're going to stop doing QT because it would crash the market. And now, there would be your event that you wake up one morning, the markets are down 5%, right? So,
right.
They can never come out and say that. But it is interesting. It's also kind of like the financial crisis in some way. Back during the financial crisis, during Lehman, we repealed Rule 157. Rule 157 under the accounting guidelines says that you have to mark to market assets like real estate. So you have to get a fair market value and mark your assets to that. Well, they repealed that rule because a lot of houses were in foreclosure and bankruptcy and nobody was making payments on houses, et cetera. And so to protect the banks, they said, oh, you don't have to mark to market anymore. You can just mark it at fantasy value. Just put it at full face value on their books, which they did. Well, we never reestablished that rule, right? The Rule 157 is still not in effect. You still can just mark things at fantasy value on your book. So if you have a piece of commercial real estate that's worth 20 cents on its value right now, you can still mark it at 100 cents on your book. So it makes bank balance sheets look very, very healthy right now. They're probably not nearly as healthy as everybody thinks they are. But the point I'm making is that all these excuses that they use are to basically position themselves for something in the future. So they say, oh yeah, we're going to repeal, we're going to stop QT for right now, because of the debt ceiling, which the debt ceiling isn't an issue. They will raise the debt ceiling. They will issue more debt because we've only done it like 29 times now since 1980. So it's a non-issue. There's no reason to stop QT because of the debt ceiling. You're stopping QT because you're worried that you're going to need to restart QE at some point in the near future for whatever reason. And you're setting yourself up for that. But it's always the excuse you get versus what's really happening behind the scenes. And what do they know that we don't know?
And I want to go back to this crisis is from the article I put out Wednesday. And I sort of lead with there was a commencement speech by David Foster Wallace. And basically what he talks, it's called This is Water. And it's kind of about a fish in water. And water is its life medium, right? Without water, fish will die, right? Without air, we die. But fish who knows what fish think about? We don't think about air. Markets, the life-saving mechanism, the medium that keeps markets around is liquidity. But we so often never think about liquidity. We don't think about the air that we're breathing. And it's so important. At times we bring it up. I mean, we're not talking about it that often. We only bring it up when we think there's going to be less liquidity or some liquidity problem. But liquidity, when there's a lot of liquidity, markets do well. When liquidity slowly drains.
Yeah, hold on for a second. You're breaking up on your end pretty badly here. But the issue is that you're trying to get to is that liquidity is the main driver for the markets, and when there's a problem with a lack of liquidity, that's where markets begin to get in trouble. And this is where the Fed has historically begun to respond by figuring out more ways to provide liquidity to the markets, whether it was the Bank Term Funding Program back during the Silicon Valley Bank crisis, or whether it was QE, or whether it was any other form of liquidity intervention they did, kind of post-pandemic to keep liquidity in the markets, because markets have to have liquidity in order to operate. It's not just the stock market, but the bond market as well.
Can you hear me now?
Yeah.
Okay. So I just think that's a critical way to think about liquidity. That is the lifeline of the market. And the more liquidity, the more efficient markets are, and less liquidity creates problems, creates volatility. And the Fed is keenly aware of that. And the Fed will always try to get ahead of liquidity problems, and they will manufacture a crisis or turn something into a crisis that isn't a crisis to do things to make sure that liquidity is fine.
Right. So get ready to go ahead and just, this morning, again, like I said, we've got, we don't really have a lot of economic data out today. We've got initial claims out this morning. Trade balance is out this morning as well. That's expected to come in at negative 91. Previous was, let me get this right. The expected trade balance this morning is negative 91.3 billion versus 98.4 billion. Now, remember that trade balance is what sunk that GDP Now report at the last read. So the trade balance today, if it improves fairly markedly, it's going to cause a big jump in GDP Now, which is also why that data will update today. So if you want to know what GDP Now looks like after this morning's reports that come out around noon today, go look at the GDP Now. Just Google GDP Now on Google, and it'll take you right to their page. And they post the graph right on the front page, and it gives you all the latest data. But I would expect if the data comes in as expected, you should see a fairly sharp jump, positive jump in that GDP Now report. All right. Earnings today: Costco, Broadcom, Hewlett Packard, Kroger's, BJ's Wholesale, The Gap, Macy's, Burlington. A lot of retail reports out today as well. That'll be kind of moving underlying the market. We'll see where the market opens this morning, and more importantly, see if we get some buying today coming in. Right after this kind of knee-jerk open. All right. See y'all back here tomorrow for Financial Fitness Friday. And remember, we're off next week. Be back the following week. But all of our shows on podcast coming up this week. Get your favorite podcast app out on your phone. Tune in to The Real Investment Show. We'll see you next week.